All right. So Julie, welcome to our video series.
Thank you.
Appreciate the participation. So you wear a number of hats at the firm. You're chief market strategist, portfolio manager, senior research analyst. So I'm really interested in your perspective, given your different roles and responsibilities to the firm on the things that we're going to talk today. But before we get started, I just wanted to make a comment or observation from, being at Kayne for 30 plus years. I think that equity investors are not often afforded the opportunity to invest in high quality businesses when they're out of favor and attractively valued. And I think we're in one of those rare moments today. So with that as the baseline kind of point of view, let's get into some of the questions. So I thought we would start out with kind of this foundational question of what is quality? So what are the kind of common portfolio characteristics that you find when you're evaluating businesses that cause you to say, well, this is a quality business?
Yeah, it's interesting, right? Because I think people assume in portfolio management that it's really just about spreadsheets, numbers, and return on equity and this, that, the other. And that's important. But really what I think we do well here is understanding the qualitative elements of a business. And for us, when we're thinking about quality, it's really about the structure and the competitive advantage.
Okay.
And any business that we look at, let's say it is in any kind of industry, what's really important is understanding who do they compete against and why do they win? And then most importantly, why do they get to continue to win? What is protecting this business and allowing it to continue to thrive? And why can it do okay even in a tough economic backdrop? So the resilience of the business is important. And I would say actually, even more so now, the adaptability, right? Are they able to recognize big changes in supply chains and adapt and figure out how to become more nimble? So those very qualitative elements are the analysis and the assessment that we do. We're more so business analysts than we are financial analysts. So we want to be able to understand a business in terms of the mechanics, how competitors work, how do they find customers, what are the drivers of growth, where do they have problems? And then when we have this picture, we want to marry that to the financials. So if I tell you that a company is, a premium priced product, it better have better gross margins than its peers, right? You want to be able to take the qualitative elements of the business and look at the financials and have them make sense together. And so when I think about the types of businesses that we like in quality, they're businesses that have a durability to them and that we believe they can sustain that durability. That's more important than just, hey, this is growing real fast. It's more important that I have confidence that it can continue to do so over the long term.
Well, that was one of my questions, but just getting back to the financials, or do you view the financials as the output, but that's not by itself the recognition of quality?
Exactly. So it's not enough to just say, wow, this has really high returns on capital. That's not enough. You need to understand why, and also, is it sustainable? So it's really important to understand the qualities of the business, and then the output are the supposedly, hopefully, very good financial performance.
Now, how about the growth profile? Where are you placing emphasis on the growth profile of the business? Is it the trajectory of the growth profile? Is it the durability of the growth profile? Where are you placing the higher level of importance?
I think when you understand the durability of the business, you know more about whether or not it's going to be competitively advantaged over time. The growth is something that's a little bit less in the management team's control, right? There can be time periods where all of us are at home during the pandemic and we're buying furniture up the wazoo, right? Management can't really control some of those growth drivers. They have some control, but not all. But what we want to know is that when growth is there, Do they capture more than their fair share? And will they continue to do so over the long term? So the durability to us is probably more important because that growth is hard to predict in a lot of cases.
And then how does the valuation of the company's stock come into play when you're considering it, say, as a new investment?
I think valuation is one of those things where, we say valuation is art more than science. And for us, we don't run traditional value portfolios where we're trying to find things that are super deep value. We actually go in with the assumption that markets are relatively efficient and we want to find our businesses at a reasonable price. Okay. We're not necessarily trying to find things super discounted. There are times where we get lucky, right? And there is a perception that, say, high oil prices are going to negatively impact a certain business and the stock sells off. And we get this opportunity and we believe that this is either transient or it won't impact the financials nearly as much as others think. So those are the times where, we sometimes get a little bit lucky. But for the most part, what we want to do is find reasonable valuations.
Okay. So can you give me a couple of examples of portfolio holdings that would be viewed as a high quality business?
Sure. I get so excited when we talk about our companies. We own a company called Bentley. Mm-hmm. Bentley is an infrastructure software company. They do a lot of the collaboration on huge infrastructure projects. So if you think about, for example, a bridge doesn't just have the architects and the engineers, but you have the civil engineers, you have everything that's happening with permitting, you have everything that's happening with the water management. There's a lot that's involved, and it's multidisciplinary in terms of the people that are involved with the business. So when you have people that are coming from very different walks of life and perspective, the software really allows them to talk to each other. Mm-hmm. When you have software like that, it's really hard to just rip it out and put something else in place, right? You have all of these people collaborating on a single project. Even if they raise prices a little bit, it's not going to be very compelling for a new upstart to come in and say, hey, I've got this great collaboration software. We maybe haven't gone through all the regulations, but you should trust us. It's that type of business where it's really hard to even imagine how a competitor can unseat you. Those are the types of businesses that we're really drawn to. Another great example is, when we're thinking about the durability of a business, a lot of times, if you're looking at, say, software, you're having to not just understand the software and technology, but the underlying end market. Mm-hmm. So if we think about a company like Jack Henry, this is a company that serves savings, smaller regional banks. These would be companies that you would think would be really negatively impacted by a global financial crisis. Mm-hmm. You would assume that anyone that was serving these types of companies would be in a lot of pain during the global financial crisis. And if you look at Jack Henry's results, you can't really see the GFC in their results. Okay. Because if you're open, you're paying them. They are the core of your whole ledger. Everything that is involved in running a bank, that's them. And you're not going to, unless you are completely shut down, you're not going to stop paying them. That is a really wonderful type of business where there is something really structural that means that even if your consumers are having a harder time, they still pay you on time. That's really important.
And when you look at, for both Bentley and Jack Henry, their addressable market and their growth opportunity, how do you assess that too?
It's interesting, right? Because a lot of people spend a lot of time on the total addressable market and what is the growth opportunity. And I think we continue to be surprised how poorly those calculations and assessments are. What's more important, I think, is understanding the level of saturation that they have within a market. And then what is their opportunity if they have a really strong market position, which a lot of our companies do, to continue to sell more incremental and add-on products. So they will give us a TAM number that's like 800 billion. And it's, wow, so impressive. Not really. What we assess more is what kind of level of growth is reasonable. And sometimes we'll do that talking to customers and say, okay, you've been a Bentley customer for 10 years. You've grown with them. What causes you to grow more with them? What causes you to do more with them? And connecting that with what their product roadmap looks like, to me, is more valuable than saying, wow, they have 8% of the market. They have so much that they can grow from here. When you're more concretely grounded in the actual product capabilities and what the consumers want, I think that that gives you more intuition about what the growth looks like going forward.
You made an interesting comment about speaking to either suppliers or customers. How often is that done? Is that always done when you're doing research on a company?
Yeah, we really try to talk to customers as often as possible. I think that it gives us a ton of insight. And what I've noticed being here, this is going to be my 14th year in June. So I'm like a whippersnapper compared to you, right? But what I've noticed is as we've grown, what's been wonderful is we have really deep relationships with a lot of companies that we've owned for 5 years, 10 years, 15 years. And so very often I'll be doing work on one company, and I know that one of our portfolio companies is also a customer. And so I can just call them up and say, hey, as your fifth largest shareholder, could I talk to your CTO about whether or not you use this product and what you like about it? And they'll give us very candid feedback that I think is really helpful in understanding granularly what works and what doesn't. Because if you talk to management, they give you beautiful, glossy perspective. And a lot of times we've asked companies, hey, can I have a customer list, or could I reach out to a few of your customers? Of course, those are going to be very cherry picked.
Right.
When we can choose the customers that we talk to, that's a much better quality piece of insight that we can draw on.
Have you ever found a situation where you've talked to a customer and that's colored your opinion on your initial thought about the business?
Absolutely.
Okay.
I think I think you learn a lot in terms of some of the more mechanical and, pedantic elements of the business. They say, this technology is so easy to implement. And if you talk to the CTO of a customer and they say, hey, we do really like this software, it was very hard to implement. And it took us a really long time, and it actually ended up being more expensive. It does color a little bit, not just how you view the product itself, but also kind of how management talks about their business. And that's important for us too, right? A lot of our businesses, the great thing about them is they generate awesome levels of free cash flow. That's awesome. However, that means that they have lots of cash that they can sit on and do things with, sometimes good things, sometimes bad things. And so when we talk to management teams and they say things like, we're very disciplined in our capital allocation, and they're very promotional about their business, it gives me some hesitation if I talk to a customer and they say something very counter to what management taught me or management said to me. So it's always helpful to have more qualitative proof points to compare the information, because in a sense, when you make an investment, there's some trust that's involved in there.
Right. So that was a great explanation, because it goes to the next area that I want to focus on, which is the current environment.
Yes.
So it's been an interesting year. It's been an interesting 12 months. We've had these massive, major macro events, from the trade wars to the war. We have one coming up with the election. But we find ourselves with most global equity markets near or at all-time highs.
Mm-hmm.
And that while this has been happening, the subset of high-quality companies has been significantly lagging the broader indices. And so I wanted to get your thoughts and observations of why you think it's happening, what kind of conditions were put in place for this to happen, and your expectations for that to evolve and change over time.
Yeah, so it's been an unusual time, especially for a quality investor. Typically as a portfolio manager, we come across a great business and a sticking point will be like, gosh, it's expensive. It's already been found out as being a great business. And so this is more than I want to spend, but I know it's a quality business. And that is typically the point of friction that we'll have with an investment very often, if it's a quality business. What is kind of interesting about right now is, we got to the end of Liberation Day. We had a lot of companies, that were talking really anxiously about tariffs. And then suddenly it sounded like tariffs weren't going to be a big deal. And that really changed the dynamic so that we were back and excited primarily about AI. And then as we started to cut rates of the Fed, we suddenly saw small cap just take off in a way that I don't think anyone could have predicted. But that was mostly in the fourth quarter. And what was unusual about it was who was driving it. And what we saw a lot of was biotech and quantum computing and companies that had no earnings whatsoever. And it's a very unusual dynamic. in a sense, you could make an argument that for biotech, most of the earnings are way out into the future. And so if interest rates are discounting those back and interest rates are coming down, that means they're worth more. So you could tangentially make an argument with me for that, maybe. Biotech still has been a place that has just been a capital destroyer for the last decade. It's not a space in small cap that we spend a lot of time in just because these are binary companies, right? They have a lottery ticket quality to them that I think almost plays into a lot of the meme stock excitement that we've seen. And I think there's a lot that can be described there. Quantum computing, I think, was a place where people felt, I can play the AI boom in small caps. This is the best way to play it because quantum is going to solve so many of the compute and the energy needs that we have with AI. Again, some of these businesses, they're not just pre-earnings, they're pre-revenue. And so highly, highly speculative and not what I would call quality. And then as we came into this year, the mix has changed a little bit in terms of companies that have outperformed in the small and mid cap indices. You've seen quality hold itself up in large cap relatively well, where good performance is connected to, let's say, return on equity. Mm-hmm. That is totally broken down in small cap. We're at a very large gap where companies with much lower returns on equity or no return on equity or negative return on equity well outperforming companies with high returns on equity. That's an unusual time period. And I was trying to think about what drives that. What's interesting and what we kind of don't talk a lot about is we've been in this great expansionary GDP economy for a while, but small caps did have an earnings recession, a real earnings recession as inflation picked up. They really had a hard time passing price increases. And we saw earnings turn negative for a longer time in small cap than in large cap, for example. Okay. So where we are now looks like the beginning of coming out of a recession, even though that's not the case for the rest of the economy. But for small cap, they are coming out of an earnings recession. And so you typically see lower quality cyclical names really catching the most investor enthusiasm when we have an expansion, because these are the most beaten down names.
Yeah, so that was the next question I was going to ask, is if you find any similarities in today's environment versus previous periods where high quality small companies underperformed.
Yeah.
Was it this, in its own version, a kind of a point of view of accelerating out of a recession kind of environment, although we haven't really seen that from a macro perspective?
Yeah, so it is very much that kind of time period where, things are going to be okay. We go to the places that have been the most beaten down because people feel like they have the most upside in those names.
Right.
And I think it's been compounded actually by the other trend that we saw this quarter, which was halo, hard assets, heavy assets, low obsolescence, very industrial names. That really drove a lot of the outperformance in the first quarter and up until year to date of companies that, have a lot of heavy CapEx and their returns on equity are quite low. They're, in many cases, commodity businesses. They're not typically the types of businesses that we're attracted to because they require so much CapEx and because their returns on equity are lower and because they're more cyclical. But those are the ones that have been really favored by investors. Some of them, you could argue, have a tangential connection to the data center build out. There might be in electrical engineering, they may be in HVAC cooling for these data centers. And so again, people are looking for ways to play the big narrative themes, and they're nervous about, they're having more existential questions about things like traditional software, which is, the types of businesses that we more gravitate to, these more knowledge-based businesses. And because there's this question mark of, is everything going to be replaced by AI? It's caused people to really move towards these CapEx industrial businesses that we wouldn't really consider very high quality.
My next question was linked to some of your comments. So historically, there have been certain economic sectors that have not been represented in Kayne portfolios. So utilities, energy, materials, as an example. And these are three areas, especially this year, where the returns have been very robust. And so I wanted to get your sense of why it's so difficult to find quality businesses in those sectors. And has your view on has anything structurally changed in those sectors that would cause you to say that their future growth and profitability profile might be different than what they've done for the last 50 years?
Yeah, I think those sectors tend to be really commodity driven.
Right.
And less so utilities, but let's talking about energy and materials. In these commodity driven businesses, you have very little control over your destiny in terms of your profitability, right? You're dependent on, certain presidents and government leaders enacting wars in order to really drive the maximum benefit in your profitability. That's not typically what we like. We really love to own businesses that have a lot of control over their destiny. And to me, materials companies that are very exposed to big cyclical changes in commodity prices, those aren't typically the types of businesses that have the kind of market control that we're really hoping for and hoping to find. We always are trying to look in materials and energy because we want to be diversified. But it's been so difficult to find anything in the energy space in particular where we feel confident that this is a differentiated business. It's better than everything else that's out there, and it can really maintain that leadership for a long time. It's just really hard to find that, particularly, I would say, in small cap. Utilities is a little bit different. The regulatory component makes it, again, very hard to say this is a very differentiated, regulated utility. They're really limited in terms of the profitability they can have. And I think it's interesting, the excitement that we saw early on for utilities is a little unusual when you think about how are they going to be able to build out their capacity within the governance of all of the regulatory frameworks and oversight that they have to manage. How are they going to really manage that? I think that's actually a pretty difficult lift for businesses that are just not used to having to grow in the level and the way that they are. These are businesses that are much more about, I always need to maintain a certain amount of excess capacity. They're really operations-driven business. They're not necessarily expansionary businesses. And so that's, again, not really the type of business that we're going to be attracted to. I don't see very much structurally changing in some of these companies or in these industries that would make us say, we can find something really differentiated and special. Someone on the team is always covering energy.
Is the universe of publicly traded companies in those sectors very large to begin with?
No, it's a really small percentage of the industry, particularly in small and mid cap. It's in single digits. Okay. So it's not very large. And I think for us, the incentive to try to find something is more about diversification than it is about, we have to recognize that this is a large part of the index.
Okay. Let's move on to AI. So obviously a major theme in today's market. I wanted to get your comments around how you consider AI as you look at new investment options, and how AI might be a disruptor for your current portfolio holdings. How do you think through that?
Yeah. So I think, someone said it best. They were saying, where are we in this transition to AI? And they said, like, what base are we on? I don't know anything about sports, but that's what everyone always uses. And he said, we're still singing the national anthem. Like, it's still really, really early.
That means it's early.
That's what I'm told. I'll just believe you on that. But okay. So it's really early. And I think what's always very difficult with technology transitions is not even just in technology, because I think everyone wants to draw the parallels with the internet, right? But other technology transitions, the steam engines, rails, they all have a similar aspect in that there is always a lot of excitement and there is a lot of overbuilding of assets. That's consistent. We've never been able to do a technology transition and invest exactly the right amount. A lot of capital gets lost in places that it doesn't really prove to be fruitful. And I think it's hard to look at the level of spend today and not feel like that's probably going to be true again. I think what's unique is that typically you don't have this level of dominant companies attacking a brand new opportunity and funding most of it through their free cash flow. We're starting to get into a place where they're using more debt products, and we're starting to see more build out in other lower quality businesses. And that's the place where I start to have a little bit more of a pause. I think when I'm thinking about opportunities for the types of businesses in a AI world, you have to really think about what does AI do really well and what can a business do to either withstand or leverage that. So I think for many of our small cap businesses, AI is going to be an accelerant. For many software businesses, the cost of developing software is now much cheaper, so they can accelerate their product roadmaps. For many industrial businesses who have been very slow to adopt any kind of digitization, for them, this can be some real jet fuel on their business in terms of driving more efficiency. So I'm thinking of spaces like in trucking and logistics. Those are great opportunities for them, and a place where I think they become net beneficiaries. That's not an AI direct theme, but that's something where they are clearly benefiting from having a more efficient operation. That's great. When I think about disruption, that's the place where we've been spending, I would say, on the investment team most of our time, is understanding the types of businesses that could be at risk and what really durable protections do we have, and to look at them very dispassionately, because many of these software businesses have been heroes for many of our portfolios. They're companies that typically have great characteristics, financially, they high returns on capital, very low CapEx needs, all of these things. It's hard to look at those businesses that you once viewed really highly and say, I have to be dispassionate and recognize, is there vulnerability in this business to disruption? So that's something that we've actually spent probably more time on than understanding the opportunities, because I think it's still pretty early right now to understand the opportunities. And we want to be careful in making the automatic assumption that the disruptors will be the ones to generate all the benefits for themselves.
Right.
If I think of the airline industry, right, we all benefited from airlines, but the airlines and the manufacturers of the airlines themselves, they didn't benefit for decades.
Right.
So we want to be careful that we're not just making the assumption that just because this has AI, it's going to generate a lot of profitable revenue.
Okay. Have you found yourself having to make an adjustment to a portfolio based on a recognition that a business has been disrupted?
Yes.
Okay.
Yes. And I think you really do have to recognize how is information changing in its value.
Right.
And I think when we see businesses that are great at optimizing workflows or optimizing anything, really, there's not a lot of structure around that business that's protected. When I think about a business where the software is, about the transactions or it's the core of their operations, most CTOs are going to be pretty hesitant to rip that out for something that is newer, lighter, more efficient. And I think what we may see is that a lot of software businesses almost become the memory of an enterprise,
right,
and that a lot of the large language models and small language models sit on top of that as a decision layer. And so it makes it easier for me to access the information that's in our ERP system in a much more natural, fluid way, but it doesn't actually change that I need to still maintain the software to hold all of that information and data.
Okay. When I think about AI over the promise of AI over a long period of time, isn't really it a productivity and improving margin story that benefits the broad list of publicly traded companies versus kind of a very concentrated few that are kind of leading, obviously, from a stock appreciation standpoint, leading the charge today?
Yeah.
Can you talk about that a little bit?
Yeah, I think it's hard because so far the way that this software seems to be working is it's really, as you say, productivity enhancing. And I think that because it's general use in its function, it applies to broadly a lot of industries. And so that's what gets people, I think, the most excited, is to recognize this is applicable in all businesses. And I think that that's probably true, but I also think that the limitations of it in terms of hallucinations, and the data needs and the costs, candidly, is quite high for some of this technology still. I think it's still too early to say exactly who's going to benefit the most. But one intuition that always gives me pause is right now, the very cutting edge of these models are borderline interchangeable. Every week we hear about ChatGPT is better, Anthropic is better. Actually, this specific model that XAI is doing is better. And to me, when you have that much change, it tells you that they're probably more commodity than they would have us believe. And look, I spend time working with all of them to see the kinds of responses. And it's true that generally speaking, they give very similar output. There's some that I prefer and that I think are a little bit better, but I think it's closer than, the valuations and this money chase would have you believe.
Have you seen your portfolio companies, management teams communicate that they've identified a use case and they're actually employing these and that's going to have an economic benefit? Or is it still too early stage for you to see concrete evidence of that?
So it depends on the company.
Right.
I think our software companies are very excited because they recognize that they're able to collapse a lot of software development and their roadmaps are looking much more robust. I own a company that they almost never make their own software. They really prefer to buy established software and put it onto their platform and sell it as a cohesive thing. And they're talking now about doing a lot more of that internally, not needing to go out and buy other companies, which is great news. That would be much my preference, but that never been the way that they had postured themselves. And they were just like, it's just so efficient. We can do it so easily now. And we have the data. We don't actually need anyone's data in order to really create great products, but it's so much more intuitive for us to develop these products. So most of where I'm seeing people talking in a really excited and meaningful way is on the software development side.
Okay. So I have a different type of question for you, a philosophical question for you. So wealth creation, owning publicly traded companies. And so you've been in the industry for a long time. Where have you've watched different methodologies of how people approach the transacting in public equities. Where have you seen significant wealth creation happen in owning publicly traded equities?
I think that, it's really interesting, right? Because we're in this industry where the imagery that a lot of people have of it is people in spreadsheets, on the phone, trading constantly and moving a lot and responding very tactically. The question I get when I'm on TV always is, how are you positioned? And we really don't do it that way here. We don't really believe that you can position very specifically for any kind of economic outcome, because candidly, if we look at the last 5 years, who could have predicted any of it? When you set yourself up to be in such a specific end case, it's really difficult to pivot very quickly. And I think that when I see how we do it in terms of finding these businesses that we have confidence are going to compound quietly over the next 5 and 10 years, to me, that is a much more stable and durable way to do it. Mostly because I know this is controversial, but I really still believe that cycles happen.
Right.
And that when we have those downdrafts, that protection on the downside is really meaningful to the long-term final number that's in the bank, in 10, 15, 20 years when we retire. So I think being able to avoid and participate so much less on those really, really intense, prolonged drawdowns is much more meaningful than being able to time the market, put yourself in at exactly the right time, make sure you have lots of cash liquid for a drawdown. To me, it really makes more sense that you focus on how long you're in the market, the time rather than the timing, and also that you are able to withstand those tough drawdowns when psychologically all of us want to run for the hills, right? But you're able to have the resolve and the resilience to stay in the market, stay disciplined, and continue to own quality. I really think that when you look at all the factors that drive the stock market, typically what you see is that quality outperforms over the long term. There are periods like right now of big dislocation where quality just does not work. But I think over the long term, when we think about stock performance, it's really about earnings and fundamentals. And I think that's what people come to eventually.
Yeah, I know I'm biased here, but I really think about our approach and of taking time to, from a almost like an owner's perspective, to think about how this business is going to progress over a long period of time. And that as an owner of a business, you are rewarded over time versus transacting in a stock and hoping you have a return over a 6-month period of time. And that's where I've seen over 30, 40 years of being in this industry where significant true wealth is created. And I think patience is a very undervalued asset in our business. And so I appreciate your comments. Did we cover everything today? Is there any areas that you'd like to bring up before we close this?
Yeah, no, I mean, I think that, I think in kind of continuing on your point, I think it's really different how we are and how we do things, because I think what we're trying to do is not create value by moving around a lot. It's to be able to create value by sitting on our hands. You know, I've been doing this a long time, and every time I am ready to make a trade, I am nauseous because I think I really recognize that it's a big decision. And to me, it's a marriage, right? I really don't want to be selling things if I can avoid it. So I think that when you have that perspective, it makes periods like right now harder because you want to make changes and make moves, right? But you have to be able to look at what you have and have the courage of your convictions to say, I own good quality businesses. I believe that even in a very difficult economic backdrop, they're going to be great. And that's really kind of how you anchor your job. My job is not trading. My job is owning.
Okay. Well, I appreciate the comments. I'll make the comment again that I started the conversation with is I think we're in a very rare time where there's an opportunity to own very high quality businesses while they are underperforming and attractively valued. And over the 4 decades that I've been here at Kayne, I can probably count on one hand the times that this has happened. And so your comments during this period of time is appreciated. Thank you.
Thank you for having me.
Appreciate spending time.
Thank you.